What's up, traders? Tyler here from Vant Trading. Now, as a mainly technical analysis trader, it's also important to know your fundamental analysis. You don't have to know a ton, but there are some few key fundamental factors that you should take into consideration. In particular, the commodities and indices and how they all correlate and react to certain news events, and how you can use the commodities and all the fundamentals to kind of gauge and get an idea of where you're going to go in the markets and in the currencies. So we're going to talk about today the dollar index, gold, oil, and US 30. Now, one thing to note is, we'll start with dollar and gold because these two pairs or indices and commodities are known as safe havens in the market. And pretty much a safe haven is somewhere where investors will flock to when you have a really weak market or a really strong market. So if you are in a market and you have negative economic sentiment or negative economic unrest, gold is usually the favored safe haven. And so let me show you what I mean. If I overlay the gold chart on the US dollar chart, and you take a look, they are negatively correlated. So when gold is rising, as you can see right here, the dollar will drop. If you move over a little bit right here, dollar's dropping, gold's rising, dollar's rising, gold is dropping. So you can clearly see that there's a negative correlation between gold and the dollar index. And that's because they're both safe havens for different types of market environments. Now, when there's times of economic unrest, which is right now during COVID, you have investors flocking to gold. As you can see, as the start of the coronavirus, the pandemic right here in March, it's done nothing but move to all-time highs. Now, during signs of very strong growth, very strong economy, you'll see the dollar being the safe haven of choice. And as you can see, if we go zoom back a little bit, in 2018 of April or March, you just see this constant rise in the dollar. And as you can see in the US 30, March of 2018, obviously there's been a constant rise in the market as well. So when you have a strong economy, you're going to have a strong dollar. And when you have a weak economy like you see right now and an uncertain economy, people will be more so leaning to gold, which is right here. Now, one thing to keep in mind when you're trading the dollar or any pair that involves the dollar, there are typically 4 economic fundamentals that you want to note and keep an eye on. And what I use to track that is Forex Factory. And the 4 fundamentals that I'm going to be listing will always be predetermined and will always be on schedule on Forex Factory. So the first one is trade balance. Now there are different types of trade balances that report, but in particular you want goods trade balance. Now what this is the nominal trade deficit, which is a very key economic factor in the economy. When imports exceed exports, that's known as a trade deficit, and when exports exceed imports, that's known as a trade surplus. Now, when you're in a trade deficit, that's bad news for the dollar because it means foreign goods are in demand, and you're importing more foreign goods than you are exporting. Now, when you're in a trade surplus, that's good for the dollar because that means that you are exporting your goods more than you're importing foreign goods. So when foreign countries buy your goods, they have to exchange their local currency for the dollar, which drives up the demands for that index, right? So if you take a look at on September 29th, right here, right? This red day, this negative day, right here. So if you take a look at this day, you see it's a negative day. Now if you go back to the Forex Factory and go to September 29th, you'll notice that the US dollar goods trade balance right here came in bad. It came in negative. Expected negative 81.8 billion, but you got negative 82.9 billion. So it came in worse than expected. So that's bad news for the dollar because you're seeing a worse trade deficit than you were expecting, which on this day you saw a decrease, a drop in the dollar. So keep an eye on trade balance, the goods trade balance when it comes out, because that will be a key factor on where the dollar's going to head that day. And right here, if you take a look, it's called goods trade balance. Now, the second factor you're going to want to take into consideration is non-farm payroll. This is when jobs are being added to the economy, and not counting farm, obviously. And when jobs are being added to the economy, interest rates may move higher, which will add demand for the US dollar and push it up. Because if you're adding jobs, that means you're going to have a more stimulated economy, a more robust economy, and you will see the US dollar get pushed up because the central banks will want to increase interest rates to kind of hone down the economy a little bit, and that will attract foreign investors. So if you take a look on August 7th, right here, this big green day right here after this doji, this big green day, that's when non-farm payroll came out. Obviously positive. If it's positive numbers, it's going to go up. If it's negative numbers, it'll go down. So if you take a look at Forex Factory on August 7th, right here, so USD non-farm employment change. That came in really good, beat expectations. So August 7th right here, you saw a big increase in the dollar. Now, the third fundamental analysis you'll be looking at is GDP. Now, there's three different types of GDP that come out. There's advanced GDP, which comes out first. Then preliminary GDP comes out, and then the final GDP comes out. Now, the most important GDP number that comes out is the advanced one, the first one, because that's what traders get the first taste of the GDP, what it's going to be like. And so that's what most traders will take a look at. Now, on October 29th, which happens to be today, the advanced GDP came out. So now if the GDP rises and is better than expected, interest rates will tend to rise as well, and then that will attract foreign investors. So if you take a look at Forex Factory today, you have advanced GDP, came in better than expected, and today you have a very strong green day, very strong bullish day. So you had better than expected GDP, you had a rise in the dollar. Now, the last economic factor I'm going to be looking at is retail sales. Now, this pretty much shows how strong the economy is, if the consumers are spending. Now, if you have strong retail sales, then you'll typically have a strong economy, which will bring strength in the dollar. Now, if you look back on July 16th, right here, this one single green day out of a negative, all this negative trading is pushed down. You had this one single positive green day. That was when you had positive retail sales, a little glimpse of hope in the market. So it had a green day on that. So if you go back to Forex Factory on July 16th, right here, USD core retail sales is what people will look at. And that is better than expected. So you saw a pop in the dollar right here. So those are the four economic factors you want to keep an eye on Forex Factory. You got trade balance, non-farm payroll, GDP, and retail sales. So pretty much anything that represents a strong economy will push the dollar up, because it means that there's going to be higher interest rates, which will attract foreign investors and increase demands. Because if you have a strong economy, the central bank will want to raise the interest rates to slow it down a little bit and increase the demand for the dollar. So anything good for the economy, anything strong for the economy will be good for the dollar. Now, with gold, it doesn't really work the same for gold. There's not really any economic fundamentals or analysis you want to take a look at. With gold, it's more so what the market's doing, what the sentiment is in the market, and what the dollar is doing. Now, because gold and dollar are inversely correlated, that's something you want to keep an eye on. So when there's times of economic uncertainty, like right now, gold's going more so sought after than the dollar. but it's kind of been stabilized a little bit, so gold's been moving sideways. But during this time, you saw a huge run in gold. Now, gold sought after during times of economic uncertainty because it's a reliable source and it holds its value really well. It doesn't depreciate. So that's why gold is the haven of choice. Now, if the U.S. dollar rises in value, it takes fewer dollars to purchase an ounce of gold, so gold then moves down. That's why they're inversely correlated. Now, it's also a good hedge against the risk of inflation because rising costs of goods and services will erode the value of the dollar. And also, as the government keeps printing money, some may fear that it could result in inflation. So now when you see that, there's positive stimulus talks, they're going to start printing money again, the dollar will go down, which will drive the gold to go up. So one thing to note that if you want to trade gold, A, look at what the dollar's doing. B, look at what the sentiment is and what type of market environment you're in. If it's a negative economic environment, you're more so going to be inclined to buy gold. If it's a strong, booming market, you'll probably sell gold. Now, one thing you want to look at is AUD/USD, right? If you're looking to kind of get a gauge on where it's going, AUD/USD historically has an 80% positive correlation with gold. And that's because USD is the second pair, so obviously the US dollar is inversely correlated. Now, this will have a positive. So if you overlay AUD/USD on gold, you'll see that, as gold right here is dropping, AUD/USD is dropping. And it moves pretty much in tandem, in sync. So as it's kind of chopping up here, grinding up here, they're both on the same thing. And as you see AUD/USD grind up, you're seeing gold grind up. So that's because USD and gold, like I mentioned, is inversely correlated. So you'll see these pairs move in tandem. And that's something you want to keep an eye on as well. If you're looking to trade kind of a pair instead of trading the actual commodity, AUD/USD is the pair to look at. But for a pair to look at if you're trying to trade oil, now let's hop on over into oil. Oil has had a roller coaster of a time right now. So if you take a look back in this, during the pandemic, oil took a huge monstrous hit and pretty much went negative. So the reason oil dropped so hard, and I want to tell you, there's certain economic fundamentals you want to look at in order that affects oil. So first off, you have supply and demand, which affects oil, and that's the biggest thing that will affect oil. But there's different things that will affect the supply and demand. So right now, the reason you saw the sell-off in oil is because there was a lack of demand. Now with the coronavirus and the lockdowns, people are working from home. They're not buying gas, they're not using oil, so there's going to be a very low demand in oil. And the problem is that since there was such a low demand out of nowhere, there was this huge supply sitting there. So there's a huge supply with very little demand. So that's why you saw this continued decrease in oil. It started drops like historically, and it went negative. Now, it's since rebounded because the economy opened up, the businesses started opening up. You started seeing a little bit of demand back in oil, trying to cut down the supplies. The oil producers like Saudi Arabia and Russia, U.S., Mexico, they all cut production to try to balance out the supply and demand curve. Well, it worked for a little bit, but now you're starting to see a little bit more of a sell-off because Germany and France and other European countries are now locking down again. And what does that mean if they're locking down? Well, that means that there's going to be a decrease in demand because people will be staying home. Now, another thing that will affect the demand in the supply and demand in oil is natural disasters. Now, for example, during the pandemic right here, if you take a look at this rise right here, this big rise on October 2nd, that's when a hurricane came in the Gulf Coast and was hitting Louisiana. Now, the reason that you saw an increase in oil is because the U.S. oil producers in the Gulf had to shut down and stop production. Now that stopped production, which stopped the supply, slowed down the supply, which then would increase oil because it's giving it a chance to catch up on supply and demand. And there's, you're cutting down the supply that's going to be out there. So that's the reason you'll see oil rise on any hurricane issues or natural disasters. And there's one other thing I want to mention that might affect oil, and I can't remember exactly where it happened. It might have happened right in here or right here on this drop. So sometimes there might be strikes, and I think this might have been in New Zealand. I can't remember exactly where it was, but there was a strike where the oil workers didn't, they didn't go to work, and there was no production being made for like a week. So with no production being made, that obviously gave them a chance to catch up on the supply and demand and decrease the supply a little bit. So you saw a pop in oil. So I'm sorry, it might have been like right around here. I think this was where it happened, where the strike was. You saw this little pop when the strike happened, which temporarily fixed the supply issue. Now, one thing you're really going to want to take a look at on Forex Factory is the crude inventories, the crude supply, right? So if you take a look at yesterday, there was crude oil inventories. Now, they expected there to be a 1.5 million inventory, but it came in as 4.3 million. It blew out expectations negatively. There's a huge increase, unexpected increase in oil supply. So what did that do to oil? If you look at the daily chart, you don't even have to look at the daily chart to see yesterday. It had a big sell-off, broke through this level of support right here, and closed below and just sold off ever since. So when you have an increase in supply like that, an unexpected increase, you're going to see a drop in oil because now it's going to take a lot more demand to combat that rise in supply. So one thing to note with oil is if you're looking to trade it or get a gauge on how it'll move, or you don't want to trade oil but you want to trade a currency pair that's kind of correlated with it, USD CAD is the pair you want to trade because historically it has a 93% negative correlation with oil. And that's because Canada is one of the top oil producers in the world. It's the largest supplier of oil to the US. If the US demand of oil rises, then you'll see USD CAD fall because Canada is in demand and we're buying oil from them. Now, if I overlay USD CAD, it's going to be a little tough to see because oil moves a lot higher in percent than USD CAD does, but bear with me a little bit. As you see oil dropping here, you can see this increase in USD CAD. Now that's a larger increase than you would expect just looking at this little pop here. That's a big move in USD CAD, and I'll show you that in a second. But as oil's moving down, USD CAD's moving up. And then vice versa, if you look right now, as oil's moving down, USD CAD's moving up. And that's because they're inversely correlated, because Canada is a huge, relies hugely on oil. So whatever oil is going to do, USD CAD will most likely do. So if you look at USD CAD on the daily, this is that little pop I was telling you. When USD CAD was popping, you saw oil dropping, right? So, and then right now you see oil dropping, well USD CAD you see popping. So they're going to be inversely correlated. So if you're looking to trade oil or get, but you don't want to trade oil, you want to trade a pair, trade USD CAD. But you can analyze oil if you want, just know that they work together. One thing to note as well is that if you're going to trade US 30 and you're trading the futures, the US market, just keep an eye on what oil is doing. Because oil typically will have change in the market. What I mean is if oil is having a big negative day, the market, US 30, is going to have a tough time moving up because US 30 usually looks at oil and what they're doing in order to gauge where they're going to go for the day. Now it's obviously not the only factor that they look at, but it does play a big role, and because that shows the economy, if there's a strong economy, if we're hustling bustling, because if there's a strong economy, you'll have high demand and you'll see oil rise. Now US 30, it won't move. It's not hugely correlated with it, but it will have a tough time going the opposite direction as oil, right? So that's just one thing to note. That's going to wrap it up. If you have any questions on what I went over, if you have any more comments or suggestions, please reach out. Let us know. I'd be happy to respond and help you out. And I'll leave you at that. Safe trading, everyone.